Understanding the One Big Beautiful Bill Act. Key tax changes explained. FAQ. Understanding the tax changes under the One Big Beautiful Bill Act. On July 4th, 2025, President Trump officially enacted the One Big Beautiful Bill Act, OBBAA, marking a significant milestone in the budget reconciliation process for the fiscal year 2025. This legislation is designed to reshape the tax landscape in the United States, aiming to stimulate economic growth through various pro-growth policies. The OBBAA introduces measures such as 100% bonus depreciation, which allows businesses to deduct a larger portion of certain short-lived investments in new or improved technology, equipment, or buildings during the first year. This approach is intended to encourage companies to invest more, thereby enhancing worker productivity, increasing wages, and ultimately creating more job opportunities. However, while these tax reforms are expected to bolster the economy, they also overlook critical issues, such as the escalating national deficit. Instead of addressing this growing concern, the bill leans heavily on political exemptions, which complicate the tax code further. According to our estimates, the implementation of this tax law is projected to boost the long-term gross domestic product, GDP, by approximately 1.2%. However, it is also anticipated to increase the federal deficit by $3 trillion over the next decade, taking into account both spending cuts and economic growth. As a prominent nonpartisan educational organization focused on tax policy, the Tax Foundation is committed to informing lawmakers, journalists, and taxpayers about the implications of this new tax legislation. We aim to provide insights on how these changes may impact individuals and businesses, as well as how policymakers can enhance the tax code for better efficiency and fairness. Below, you will find a concise FAQ guide regarding the OBBAA. Disclaimer. The information provided in this FAQ may not be applicable to your individual tax circumstances. For specific inquiries related to tax preparation and filing, it is advisable to consult a qualified tax professional or the Internal Revenue Service, IRS. The Tax Foundation is unable to address individual tax situations or assist with the tax filing process. Tax tips for 2025. 5 key changes you need to know. Get ready for a new set of tax twists and turns. As we navigate the tax landscape in 2025, there are some crucial changes that financial advisors need to be across. While we won't dive into the political nitty-gritty, it's important to understand the practical implications for our clients. And trust me, there are some interesting twists and turns that could impact your clients' tax situations. Let's dive in and explore 5 key changes that you need to know about. Standard deduction, a higher threshold. The standard deduction has seen a boost, increasing from $15,000 to $15,750 for singles, and from $30,000 to $31,500 for married couples filing jointly. This could mean fewer people will choose to itemize their deductions. As an advisor, it's crucial to consider bunching itemized deductions to maximize tax benefits. This strategy can help your clients make the most of their deductions and potentially save more. SALT deduction, a breath of fresh air. The 2017 tax bill limited deductions for state and local taxes to $10,000, which was a big blow for residents of high tax states. But here's the good news. Starting in 2025, that limit is increased to $40,000, providing some much-needed relief. This change means more of your clients will itemize, and those who already do could see their write-offs increase by up to $30,000. It's an opportunity to advise your clients on decreasing withholding or estimated tax payments, and even boost their Roth IRA conversions. Senior bonus deduction, a silver lining for seniors. Taxpayers age 65 and older are in for a treat with an extra tax deduction, regardless of whether they itemize or not. This bonus deduction is worth up to $6,000, and it's available to individuals with modified adjusted gross incomes, AGI, of up to $75,000 or $150,000 for married couples filing jointly. It's a great way to reduce taxable income for senior clients within these income limit. For married seniors with modified AGI below $150,000, their taxable income could decrease by as much as $13,500 for non-itemizers, or a whopping $42,000 for itemizers in high tax states. As an advisor, you can help your senior clients plan for these changes and consider decreasing withholding or estimated tax payments. It's also worth exploring Roth conversion opportunities and qualified charitable distributions to make the most of this deduction. EV and clean energy credits, a temporary boost. The Tax Act has some good news and bad news when it comes to electric vehicles, EVs, and clean energy. The $7,500 tax credit for new EV buyers and the $4,000 credit for used EV buyers are set to disappear after September 30th, 2025. Additionally, tax credits for energy-efficient home improvements, like rooftop solar and efficient windows, will also end after December 31st, 2025. If your clients are considering EVs or energy-efficient upgrades, now is the time to encourage them to take action before these credits expire. Charitable deductions, a complex picture. Non-itemizers can deduct up to $1,000 singles and $2,000 married couples for charitable contributions. For itemizers, the deductions are more complex, as they can only deduct contributions in excess of 0.5% of modified AGI. For example, if your client's modified AGI is $100,000, they can only deduct charitable contributions beyond $500. The analysis of itemizing versus claiming the standard deduction gets even more intricate in 2025, especially when multiple provisions of the new law come into play. If your client is affected by the higher standard deduction, the increased SALT limitation, the senior bonus deduction, and charitable contributions, it's a good idea to work closely with their certified public accountant to navigate these complexities. Digging into some familiar changes. The Trump tax law brings a whole host of changes, and this article only scratches the surface. Understanding these nuances is crucial for proactive planning and ensuring that your clients are prepared for the tax year ahead. Stay tuned for more detailed guidance as these provisions take full effect, and let's continue collaborating to provide the best service to our clients.